You do not want to miss this episode. Today I'm talking to Shane Unruh. He's from Edmonton from Excess Asset Management. He's in the multifamily space, investor. He's also a manager of this multifamily, and we're going to talk about the pros and cons and why it may be time for you to look into multifamily. Hi, everyone. Welcome to Control and Compound. My name is Darren Mitchell. So, Shane, we met at the multifamily conference in Toronto. You guys had a very impressive booth with those cowboy hats. You guys are magnets. The crowd loved you. And it was real interesting learning about your company. And we chatted, and I said, I think my listeners would love to learn more about what you do and what's going on out west. So tell us about your company and kind of how really you got started in the real estate business.
Yeah, well, first, thanks for having me on. You put out a lot of great content and stuff. It's very much appreciated. So I actually grew up in Manitoba, so that's kind of where I started. Farmed my whole life. I opened and ran a gym for about 6 years. I'm someone who likes scale, so pretty quickly the gym got as big as it was going to get, and I didn't want to continue with that model, so we started looking for something else. Read an article called Mobile Home Park Millionaires, and then I guess it was just fate. The park in our town went up for sale. So that was kind of my first foot into real estate, was in the mobile home park space. So we bought a park thinking it would be passive income, and quickly learned there's nothing passive about it. We bought a second park and started that business, and again realized you can't scale it very, very big in Canada. There's not enough parks. So we transitioned into multifamily in 2020, moved out to Edmonton, and started the company we have today. So we have just under 400 doors now, and growing every day.
Wow. Very cool. So tell me about the multifamily, like the market right now. Like, what's the current state of multifamily? I know in Canada we don't have enough homes, but the prices have shot through the roof, and it's hard to find. I know in the single family, especially, anything remotely cash flow positive. So what's the current state of the market in the multifamily?
Yeah. So one thing about multifamily or real estate in general is it's very regional, right? So what's happening in Toronto isn't the same as what's happening here. So it kind of gets painted with a brush because Canada's so small, and it's like, real estate's bad or it's good. In Edmonton right now, it's finally a boom. Like we've had for years and years, it was pretty flat. Rents didn't really move, from 2011 on. And now we're seeing a ton of rent appreciation. We have so many people moving here, and we, like you said, we're way undersupplied on housing across country. We're one of the few places where it's still affordable to move, and that's what's driving this boom here. So, our rents in Edmonton could double, and we would still have a better rent to income ratio than Toronto or Vancouver would, right? So we have a lot of room to move. Alberta is one of the few places where we have no rent control, so it's a free market. We can raise rents as demand requires. That's also why we have a lot more supply, is because people want to develop in a place that's landlord friendly.
So sorry, you're telling me when you buy a multi-million-dollar property with your money, you can decide who lives there. You can not let them live there if they don't pay, and you can increase the rent if your costs go up. Like it's almost like it's free. Like freedom out there. That's fantastic. So like, what would be the average rent for a 1 or 2 bedroom place in Edmonton?
Yeah, it's going up a lot. Like your one bedroom, you're you're probably at 1,100-1,200. It depends on the, if it's Class A or C, but it's still, it's very affordable. Like we're probably at 35%, the ratio of income to rent or income to housing. So it's still a lot. As you know, across country, it's the most unaffordable time in the history of Canada to buy a home. People talk about a lot in the 80s. Interest rates were 20%. But if you look at what people were making in the 80s and what the home cost was, we're about 4 times that today. So it is the most unaffordable time. So what that does is it slows single family homes getting built, and it pushes more people into renting, because even if you're paying $2,000 in rent, that doesn't mean the bank will give you a mortgage to afford a $2,000, that you might not qualify for it. So the single family space, we used to build 1 single family home for every 4 people of population growth, and I believe that number is 1 per 60 people today. So we're so far away from a solution. It's crazy right now. Like we're going in the wrong direction, and I don't know what the path out is right now.
So you mentioned, Edmonton not being the same as Toronto. That's a great point. Is it just Alberta that you're investing in? Or are you looking in other provinces as well?
Yeah, right now it's just Edmonton, and the reason for that is we self manage everything, and I think you need scale for that to make sense. So when we hit 1,000 units, hopefully in the next 2 years here, that's when we'll start looking at other markets. I also think, if I were to pick a market in Canada, it's Edmonton. There's so much room, right? We even lag Calgary as far as rent growth, but usually we're 6 months to a year behind. So if that, once that hits here, we have a lot of upside. We're still buying stuff. Usually it's above a 5 cap, which you're not getting in a lot of places in Canada. And so as soon as we hit the scale we want and it makes sense on the management side, we will be looking at other markets.
So when you're looking for properties, what are the strategies, or what do you do to identify a property that makes sense for your model? Like how do you find those properties, and what's kind of your criteria?
Yeah, so we have a model. I call it stabilized value add. So we're not heavy value add where we go in, try to get people out, renovate the whole property, and try to pull money out right away. To me, I don't like risk. There's too much risk there where what are interest rates like in eight months or 18 months when you want to refinance that. I like long term. So we need it to be stable enough that we want to put CMHC debt on day one. So that's the first thing we look at. It has to be stabilized, and then there's some value add, even if it's just operationally, right? We like properties that are around 100 units just for the scale. It's a lot easier to manage. So it kind of limits us on there's only so many properties that are going to come up in a year in Edmonton on that side. We kind of lucked out. We moved. It was right during the shutdown of COVID, so we kind of got ahead of the line. We bought some properties during that time when a lot of people weren't. So we're on a pretty short list that gets to see the properties that do come up.
Yeah, and I mean multifamily. It was kind of super popular there for a while. I'm not sure what the status of it is now, but it's the same as when people first get into real estate. Oh, this is easy. I'm just gonna buy a place and rent it, and then 6 months go by and the tenant hasn't paid, and the roof goes, and you're trying to refix this. So what are the challenges people face when trying to do multifamily on their own, and how do you solve that for them?
Yeah, I think the biggest thing is it's like right now it's still a pretty hot market. So when there's a lot of people that want to buy, you coming in never having bought a property, the odds of you, like a lot of people are looking on MLS and think you're not seeing the good stuff will never get there, right? It'll get sent to a very small list of people. If they don't want it, it gets sent to another list. And if none of those people want it, it's going to be listed publicly, usually is the way it would go. So if, what are the odds that you just happen to find that one perfect deal, right? The other problems are, for me, the business works at scale and it doesn't work well small. And everyone has their own opinion on that. And usually you do have to start small. But we had this happen with us too. We bought an 8-unit. The margin is so small there, where if two people are moved out, you're putting a lot of money into that property to cover it, right? If a roof goes on an 8-unit, it's going to cost almost as much as if it goes on a 100-unit, right? Like it's not but because you still only have one roof. So there's all those things where at scale, it doesn't work well. New investors, what I always caution them is, and the government with CMHC having 5% down 50-year AMs, you can get a property way bigger than you probably should get into, right? So if you only have $50,000 and you decide to buy a $1 million property because you're like, this is awesome, I can get in here, you have a 1.1 debt cover. The odds of you actually cash flowing anything or not being cash flow negative or not having, one thing goes on that, you're putting another 50 and now your return's cut in half. So I think don't over leverage at the beginning, and you want to be, if you want to be invested in scale, you're probably going to have to do it with someone else. That's kind of what we were set up for. It's business professionals or, doctors, lawyers, people who don't have the time to do it themselves. They like the idea of it. So we tried to structure our fund. So it's very similar to you buying it. You just don't have the headache of managing it, and you can be part of a bunch of bigger assets, not just maybe one smaller one.
Yeah, so people that want to get into the real estate game, they like the real estate returns, but they don't want to, they don't want to deal with tenants, termites, and toilets. So what would be like a typical, when someone invests with you, are they buying a part of a building or is it part of a fund? How like if someone has like $100,000, they're looking to put into an investment and they come talk to you, where would that money go?
Yeah, we do it as a fund, and I do it that way. When you do deal specific, again, there's risk associated with it where that you have one loan that's coming up on a set date, right? So if that loan came up when interest rates were at an all-time high and you thought it was going to come up at 2%, that return changes a lot, right? Or when you take over a new property and something you didn't see happens, or a bunch of people move out, that really affects that. When you come into a portfolio, so they're coming into the whole portfolio, you kind of blend that. So now we have loans coming up in 2026, 2028, 2030. You spread out the risk. So we're going to hit some at the top, we'll hit some at the bottom, but it's not all happening at the same time. And you also have hundreds of units that are cash flowing into the fund. So if you bring a new property in and it doesn't do a return the first year, whatever the case is, it's not dragging it down like it would if it was a single investment.
Okay, so on that $100,000 example, is there a monthly, quarterly disbursement, and what kind of income is that traded in? Because again, I've done private lending, I've done multifamily, and private lending sounds sexy until you pay, in my province, 54% tax on your gains. So if you put money into the fund, when do you gotta get it back? And then what about payments?
Yep, for sure. Yeah, so I'm on the same page as you there. So when we started, we set it up. We wanted it to be like people were investing. So we actually send out monthly distributions. So every month, as soon as you put it in, the next month you'll get a check. And we do it. It's return of capital first. So I know you talk a lot about being able to kind of defer taxes out and let your money compound, and that's kind of what we wanted to do. So it's it's not tax free, but you're able to defer taxes out. Sure. 8-10 years, because you're getting it as return of capital. So there's no tax on the money that's coming out. And then we have depreciation inside the fund usually to eat up the return that would be in the fund, right?
Okay, so I get monthly distributions, and then is there a hold period that I've got to hang on to the fund before I can sell it? And how long is that?
Yeah, so we didn't want it to be a bank where money's in and out right away. Again, I don't like risk, so we tell everyone it's an 8 to 10 year hold period, and I kind of relate it to flying a plane. It's like if the pilot dies and I'm on a plane and I have to jump in there, if we have a tiny little narrow runway on an island, we're probably not going to make it. If we have a runway that's maybe 10 miles wide and 10 miles long, and I have someone walking me through it, the odds of us landing are a lot better. So that's kind of how I look at this. It's like in a 10-year window, we know that we're paying the mortgage down at this percent. We know that on average, we're going to outpace inflation on the upside of the property, right? Not every year. We're going to have downs and ups, but we're not losing money when it goes down because we're not selling the property. So you can kind of see what the upside will look at. You can underwrite very conservatively and put some upside in there. We know we're paying the mortgage down. We know we're getting cash flow of this every year. So it's a lot easier to say, hey, here's a stable, much safer investment, but it's over a 10-year hold period.
Yeah. Okay. So you mentioned, people over leveraging. So how much leverage would you have on a typical property, and what kind of amortization?
Yeah, it all depends. So right now, the way the market is, I think it's kind of by design. The government, they put in that CMHC program and almost forced everyone to do it, because there's three things attached to it. There's the you can either have affordability, accessibility, or environment, right? So they've made it the market today, because cap rates and interest rates are basically the same. So there's very little spread there. So you have to amortize it longer, right? And I haven't seen a deal like when we started, everything we did was 15% down 40-year AMs, and it worked. Cash flowed great. It worked. Now you do have to take that loan. It's just there's a big difference in having the capital behind. You have a big reserve fund, and on a bigger property, there's a lot less risk. On 100 units, I would need 20 people to move out to have the same impact that I would 2 people on a 10 unit, right? So the risk kind of goes down. You can have reserve funds spread out across the fund, and so now a lot of the stuff we take, we'll look at the 5% 50-year AM, just because that's where the market is today. And hopefully it goes back, but I don't see it.
Yeah, could you just educate us a little on the CMHC? I know the big picture of it. One of the three things. Could you just walk through sort of a couple of the details on that?
Yeah, 100%. This is also a big reason why Edmonton is one of the few places that work. So basically, the way it works, you're allowed to take a 50%, a 50-year amortization, and only put 5% down. and you only need a 1.1 debt cover. And that's where people get in trouble, because if, again, on a small property, if you put 50 grand in order to get that loan, you only need $5,000 of cash flow. Well, that's one person stays too long in a unit and you're underwater but they do it. And then there's a point system. So you either have to make a certain amount of rents affordable, a certain amount accessible to handicap people, or energy efficient. You have to make the building energy efficient, and they just lowered that. So basically they're trying to push everyone into this affordable rent part. The reason it works in Edmonton is they use an average rent. So here we can go all the way up to 1680 and still be considered affordable. And then once it's in there, then you can raise it by the CPI. CPI the last couple months has been like 15%. So even in the affordable units, or 13%, we can raise them 13%. So here it works great. Where it doesn't work is when the average rent is, there's cities in Ontario where the average rent's 2,000 and they're saying that the ceiling rate is, much lower than that. So rural Alberta doesn't work either. So I looked at a bunch of townhomes in a smaller city in Edmonton, but they were only allowing us to go to I think 1,100 or 1,200, right? So there's lots of cities where the average rent is too low and that program doesn't work.
So you tell me the rules for that program are exactly the same whether you're in Toronto or Edmonton?
Well, they take an average rent though. So like here, our average, and it's based on income, and they have a formula that they use. So a lot of places it doesn't work. Saskatoon, I don't mind the market, right? It's very similar to Edmonton, but you can only go to, I think it's like 1,200. So you can't buy a new property and go to 1,200, right? You can't build a unit for 400,000 in Toronto and only be allowed to have, I don't know Toronto's number, but it's probably 1,700. So, it's not a lot. It's not near what you would need to get, right?
Just want to say, like both in Halifax and Toronto, I'm more familiar with those markets, and everyone's doing the the environmental efficiency on electricity, because they don't want to lose money by charging grossly under market rents. And is that for 10 years? Yeah, you have to do it, or is that for the life of the building?
So you can do different things. You can do 10 years, or you can lock less of them in for 20 years. Is the way it works.
And then you get the 50-year amortization. And what about interest rates? Are they comparable to someone outside the program, or are they better as well?
They're usually better. Yeah. They're better than a standard loan for sure. Like, I don't know, I don't know what you'd get if you'd be at 6% today on a regular loan, something like that. And like CMHC, they went up a little bit this month, but I know we looked a couple of weeks ago and it was like 4.1%, somewhere like that.
Wow.
So it's still not bad. I mean, the last loan we took was 4.6. The one before that was 4.2. And those were both in the high interest rate environment. So
very cool. Okay. So you manage the properties yourself. Can you kind of walk through your approach to managing, and what are the best practices to follow, in your opinion, when you're managing a multifamily?
Yeah. And I think this is the most important thing. I think this is where you see, when the tide goes out, you kind of see who's naked kind of thing is it's very easy. Like I said, with the 5% down, a lot of people might have connections. They can raise the capital. You can buy a property. It's the managing that asset over the next 10 years, in my opinion. That's where you can get so much upside and do it properly. Your biggest expense is always going to be turnover. So we spend a huge amount of time, and we have a really good team on the management side to keep that down. So we have a tenant incentive program, which incentivizes them to stay instead of incentivizing new people to come in. And it's, on the management side, it's communication. It's people's biggest investment generally is their rent, right? They're paying $1,000, $1,500 a month. That's probably their biggest payment. They want to be heard. They want to be communicated. And, as a manager, or for sure when you're a small owner, if you just have one property, you're like, I'll push that maintenance off. It's, it's going to cost me a couple $1,000 and I can wait. Well, to that tenant, that's their home, right? They're having guests over. They don't want that. So if they move, you have all the expense of re-renting the unit, marketing it, all that stuff. So that's where, if you can focus on the management side of it, and I think that's where we have a big edge, is we spend a lot of time there. In the good times, everyone looks great. Like right now, rents are going up. You don't see a lot of stuff going bad. But when the bad times come, vacancy creeps up, rents go flat. That's when I think you'll see the difference in people who actually manage the property correctly, and everybody who just bought the property. A lot of these companies are based on acquisition fees. That's kind of how they structured their company. So it's like they're just buying as much as they can. They don't really care if they're getting a big return, because they make the money on the acquisition fee. I never wanted to do that. I wanted to build a portfolio that I want to hold my kids can take it over. We want to hold it long term. So we buy only, we're pretty specific on the assets we buy. We want to manage them correctly, spend the money so the building keeps up, long term.
Cool. So what do you think the trends are going to be in multifamily? Before we went on air, you and I talked about AI for a bit, but that's going to change a lot of businesses. We're always going to need people. Are always going to need to live somewhere. So I don't see, in my limited knowledge, I don't see any massive changes. But what about in your end? Are there any going to be trends or opportunities to look for in the next 0 to 20 years?
Yeah, that's like you talked about. That's one of the reasons I like it. Is it's the oldest industry basically, and there's not much that can replace someone needing a place to live. If I were to guess, I would say the thing that I think happens in the next 20 years, we see home ownership decline more than it already has, and it's not a good thing. But a lot of people, will get called to an apartment because they don't want to change a battery and a thermostat, or they don't know how. Those people don't want to own a house. They want like a lot of younger people, they don't want the headache. They don't want to mow a lawn. They don't want to, have the headache. They want to move every 2 years to a different city. So I think you'll see that in the younger generations coming up, less and less people want the headache. And I think you'll see more and more renters. I don't think it's necessarily good for the country, but I do think there's a lot of upside, even on the financial case. Usually home ownership, if you factor in, out there, land transfer tax, selling every couple of years, you have you have the interest costs, you have property taxes. I think, you could make the case for renting from a financial standpoint as well. It would,
Yeah,
if you were investing your money smartly somewhere else.
yeah. I tell people all the time, like, do you want the financial advice or the life advice? Like, I've got young kids, and they want homes, and I don't blame them. I wanted a home to raise my kids in, but before, we could always make the argument that the math works. You can't always make that argument anymore, but there's some things more important than money. What about some niches? Like, it's funny, I just closed on a condo, and the big thing was, get your EV charger installed when the building was basically going up, right? And it was going to be like 10 grand or something, and then afterwards. So do you see any like niche markets you think will develop where people will, you know, look for the grocery stores in the basement, look for the smaller footprint that they can walk to? Like, what you got pretty spread out city out there, but any niches that you see coming in the multifamily?
Yeah. EVs, I'm in Alberta. I think they'd sit empty. I don't know if the chargers
Yeah,
would be the one,
exactly.
but yeah, I think it's just amenities in general. Like if you think of someone coming out of college and going to live somewhere, if you have a place that has a pool and a gym, and yeah, you might have a grocery store on the main level, you'll have probably a co-work space in there, and the rent's $2,000, or you could go buy a house where you're gonna have all the headache of it, the maintenance. You're gonna have none of that stuff. I think people who want to live in the cities. I think it's just you're going to get these buildings that are so amenitized, and that's appealing to a lot of people, right? You're going to be right downtown. Maybe a lot. I think you have less people driving, so you have all of the upside and really none of the downside. And the home ownership argument that I always get is people like, well, it's something I own, right? It's something I can't. I said, well, that's great, but don't pay your property taxes for a year and see if you own it. Don't pay your utilities, and that don't pay your mortgage. The bank takes it. So most people live in a house that the bank owns 85% of it anyway, and you're tied to it, very similar to, you maybe can't get evicted quite as easy, but so I just think it trends that way. And unless something changes, but we're in such a housing crisis, and to build, we build about 220,000 units a year. If those were all single family homes, we build half that, right? You have to build up, you have to build. That's just the way we're designed, and that's the way I think we go. So I think amenities draw people in. They're very expensive to run. We have a pool at one of our properties. I would love if it was filled in, but that's the way it is.
That's what they're looking for. Yeah. No, it's funny you mentioned that. I went through the exercise with some clients in the past where, they're going to sell their house and move into an apartment, and it's like, oh, all this money I'm going to get for my house is just going to go away. And you just start asking them questions about, okay, well, what are your property taxes a year in your paid off house? well, what is your electricity or hydro bill on your house? What is your upkeep on your house a year? And you start adding it up, and most of these people, they're $1,000, $1,500 right off the bat. So then they look at a $1,700 a month apartment or whatever it was at the time, and it's like, oh, well, I don't have to spend all that money I sold my house for. That, wow, I didn't, because they think they have this paid off house and it's not costing them anything, and that's far from the truth.
Yeah. And that's the thing. It's like, what, do you trust that the government isn't going to come after personal home, capital gains at some point? Like, it's all good to have that house paid for, but that's debt equity. That's what I always tell people. Like, you have $100,000 sitting in your house. What does that help you when you retire? Unless you pull it out and then have a mortgage again, it doesn't help you a lot, right? If you sell your house, now the price of housing's up, where are you going to go? Unless you go to rent a place later on in your life, which probably will happen as well. There'll be better seniors communities and stuff. But yeah, it's, again, I'm pro home ownership. It can be great. I think the vast majority of people don't have, it's a forced savings account, and it's forced, and that's the best part of it.
Yeah.
But you can get burnt too. Like, we've seen houses until now in Edmonton, the difference between houses that were in, 2011, 2017 to now, you're probably losing money selling them until now when they've went up. But there was a flat period there where you were making, you were paying property tax, you're selling the house, you're giving the realtor 6%. You're not up a lot, right? You might've built a little bit of equity, but if you were paying rent that was half of your mortgage and actually putting that into a smart investment, I think that's a good option too.
Cool. Okay. So do you have any success stories or memorable experiences you can tell us about your real estate journey where it was like, well, that was pretty cool. I bought this and sold it, or I did something, or just something memorable. I always love good real estate stories.
Yeah. Well, I think it was just the first time we really, we kind of had two, like when we bought the trailer park, like I said, we were going to buy it and just kind of hold it forever. We were planning to live in Manitoba at the time. And I had met a guy, and he was telling me how he was doing with apartments where you would, you get the rents up and you pull the money out and do the whole program, right? And so I kind of looked at it, and in Manitoba, there's very strict rent control. You have to go through the government. It's a whole big program to do it. And we decided to do it with the park, but it was just the first time we did it, right? We applied for the rent increase. We got it cut in half by the government, and we'd already sent it out to the tenants, and it's the whole process. But you could see where within, I think we'd owned it 2 years, and we didn't quite double the property value, but it went up a lot. And I had ran businesses. I farmed my whole life up until that point. We'd ran a gym for 5 years. So I was at that gym 12 hours a day, 7 days a week when it opened. Like, we were spending all that time. And then you could see the power of real estate when you're using a cap rate and income to come up with a value. You don't need a lot of income to get the value up. And when we actually did that and did that first refinance where we could pull a bunch of money out, that was kind of an aha moment for me when I was like, sure, it's not passive, but I would have had to work a lot longer on my business to get that upside, right? And it's kind of similar now. We can look at, you don't always have, the cash flow isn't going to be near as good as in a operating business, but the upside is good, right? You're sitting there, you're building wealth over time. And that's,
yeah. I mean, a small increase in rent or a slight decrease in expenses can drastically change the value.
Yeah. And I think that's what people miss. If you use a 5 cap, $1 is worth $17 of upside, right? So you get rent up $1 on 100 units. That's easy to do, right? You get rent up $10 a month. So over 12 months on 100 units at a 5 cap, the value goes up a lot, right? You don't need to create $1 million on a 100 unit building. You don't need much. I think you need a $27 rent increase, or it's not a lot of money that you need. So I think that's what a lot of people miss. They're just looking at the cash flow or things like that, and there's a lot of upside there because of the way the buildings are valued. And if you're good on the operation side, it definitely can be done.
Okay. So what advice would you give someone thinking of getting started in the multifamily? They've gone to the multifamily conference, or their buddies doing it and making all kinds of money. Someone looking to dip their toe in the water, what kind of advice would you give a new investor into the multifamily?
Yeah. The first thing I tell everyone is, what is the long-term plan? Like, do you want to do it as a job? Do you want to do this as full-time? Maybe you'll accumulate a couple hundred units and that's what you're going to do. Or do you want it as an investment? Because those are very different things, right? If you want to dip your toe in and just kind of have a passive investment, don't do it that way. Invest with somebody else or partner with someone who's doing it, because doing it on your own, it's not going to be fun to be at your job and getting the call to go fix something. And if you use third-party management, it doesn't, it's not the same. Then you may as well be partnering with someone anyways. So I would say that if you decide, no, this is what I want to do, and I only have this amount of capital, I always tell people, just be very clear. The brokers are kind of your in between, right? You need to find a really good real estate agent who's going to find you these deals. They're making all their money only if that deal closes. So the last thing they want is a new guy coming in saying, yeah, show me some property, right? They don't know. You be very specific. Say, I have $100,000. I'm looking for a 4-unit property. Here's the neighborhoods. I don't want brand new. I don't want it really old. Be very specific on what you want. You can even show them that you have the money. Try to build, like when we put an offer on our first property, because of the way the market works and they want security, we basically had to write a resume that said, like, hey, we've owned mobile home parks. We just did a refinance. We have the capital. We're going to self-manage and all of this stuff. We were the only offer because it was right during COVID, and just for them to accept the offer. So I think build that story at the beginning, decide what you want, what product type you want, and understand that in today's market, the pro forma can say any number at once. The reality is you're probably not going to get a lot of cash flow, for a couple of years, but it's going to be you rarely find someone that loses money over real estate in 10 years, right?
Yeah.
It's when you try to do quick stuff in and out. So I'd pick a safe strategy and build your story.
Yeah. And I'm a huge believer in collaboration, because I would rather 10 or 20% of something good that I don't have to be hands on deck every day versus 100% of a major potential loss, pain in the butt, all kinds of time, energy. And I just find so many people just bite off more they can chew in the real estate, because they get excited about the numbers, but they don't appreciate all that can go wrong and will go wrong. And then just the time and effort just to manage, even if things don't go wrong, to manage properties. I can't do it. I've tried. I can't. I just don't, and again, I'm busy, right? I'm running a business. I don't have time to do that. So I like being a passive investment. So if people are interested in more passive investment, but they want to get into multifamily, what's the best way to learn more about you and get in touch with you?
Yeah, if it's me, I'm pretty easy to find on any social media. It's just Shane Unruh. I have a podcast, Scaling Up with Shane. As far as our company, it's Excess Asset Management. And again, you can Google us, go on our website, or we have social media as well. We're pretty easy to find.
Excellent. Well, I thoroughly enjoyed this. I love learning more about multifamily, and I think there's real opportunities in the western part of this country. Some of the major big cities, Toronto, Vancouver, I think it's real tough to find the right opportunities. So I'm excited for our listeners to learn more about the West and contact you if they're interested. Appreciate your time today.
Thanks for having me on.
All right. Thanks for watching. Thanks for listening. Have a wonderful day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.